Yesterday, I made the decision to sell all of my shares of QYLD after coming across this investment about 4 years ago. Given how well this ETF has been doing over the last year, I figured now would be a good time to sell my shares of this fund and put all of my capital gains into a different, brand new ETF that I've been eyeing for a couple of months. QYLD was the very first covered call fund that I had ever invested in, but I feel like it's undeniable at this point that newer CC funds with improved strategies have since been introduced since I first bought into QYLD, which is why I made this decision. So in this video, I'm going to explain my history with this ETF, and I'm going to talk about why I decided to sell out and also where I'm investing my capital gains and why. When I first came across the Global X Nasdaq 100 Covered Call ETF, aka QYLD, about 4 years ago, I was immediately drawn to it for a couple of reasons. The biggest reason, as you can probably guess, was its high dividend yield. This ETF consistently yields between 11 and 12% and also pays monthly dividends to shareholders. Another reason I was drawn to it was the fact that I viewed it as a way of collecting dividends from a sector that doesn't normally pay dividends, which is the technology sector. The Nasdaq 100 index is overwhelmingly made up of tech stocks, which don't usually pay dividends due to these companies wanting to prioritize growth. So having an ETF use a covered call strategy on these types of stocks was an additional way of diversifying my sources of income in my portfolio. As far as I know, the Global X exchange-traded funds were the first ETFs to use a covered call investing strategy, in which the fund buys all the stocks in an index and sells corresponding call options on the same index. Following my investment in QYLD, I also bought 2 other funds by Global X that follow the exact same strategy. I also bought XYLD, which is their S&P 500 covered call ETF, as well as RYLD, which is their Russell 2000 covered call index fund. Between 2020 and probably 2022, QYLD began exploding in popularity, and a lot of other dividend investors here on YouTube began investing and covering this covered call fund. And as a result, I just think that other ETF providers probably took note of just how popular QYLD and its covered call investing strategy had become. I honestly believe that companies just really took note of just how popular CC funds and income investing had become, even among people who aren't yet fully retired. And so what we've been seeing in the past couple years is other companies coming out with their own covered call funds, most of which have strategies that make them different from Global X's. Some notable examples would include JP Morgan, who introduced JEPI in 2020 and JEPQ in 2022. We also saw NEOS come out with their own S&P 500 covered call fund with a differentiated strategy in mid-2022. We've seen YieldMax introduce more than 24 covered call funds in the last 2 years. Some other smaller companies, including Crane Shares, Defiance, and Rec Shares, have also released their own covered call funds. Even Goldman Sachs and iShares have been releasing their own covered call ETFs, indicating that these ETFs are here to stay in terms of being a mainstream type of investment. But since QYLD came out back in 2013, and after I made my investment in this ETF, other similar ETFs have since been released that have improved strategies. These strategies include things like better downside protection when the market falls, and even higher yields with better tax treatment in some instances. So with this in mind, I decided to sell out of QYLD in my portfolio, taking a capital gain of over 15%. Having done that, I decided to use the proceeds to buy into a similar ETF that also uses a covered call strategy on the Nasdaq 100 index. This fund was just released about 2 months ago, but going forward, I do believe this ETF is going to be the superior performer. The newest holding in my portfolio is QQQI, which is the NEOS Nasdaq 100 High Income ETF. Now, normally I wouldn't consider buying into an investment that's this brand new. I usually like to wait until a stock or an ETF has established some kind of consistent track record before I invest, usually at least a year. But the reason why I bought QQQI already is because this fund is basically a carbon copy of SPYI in terms of strategy. The only difference is that QQQI is on the Nasdaq 100, whereas SPYI is for the S&P 500. I recently made a video on where I discussed why SPYI is currently my favorite income holding, and most of the exact same reasons apply for this ETF as well. Comparing QQQI to QYLD, the NEOS fund has better downside protection. When the Nasdaq 100 goes down, both QQQI and QYLD will also go down, but QQQI won't go down as much as QYLD due to NEOS having a better covered call strategy with their ETF. Likewise, when the Nasdaq 100 is in the green, then QYLD is going to be more capped in terms of upside potential. So the NEOS fund will have higher gains in share price when the market is up than QYLD will. So that fact alone would make this fund a better choice in my opinion, but it gets even better than that. We've seen that since its launch, SPYI has been able to provide investors with a very consistent yield between 11 and 12%. The NEOS ETF, on the other hand, has been able to deliver a dividend yield of almost 14.5%. This makes it one of the highest yielding investments in my dividend portfolio, and if this ETF does act in a very similar way to SPYI, then this should be pretty consistent. A diversified ETF offering a yield this high is almost unheard of. I can think of the PIMCO funds like PDI, for example, that offers a similar yield, but these investments hold some pretty risky investments, so I would not consider recommending these to someone who's risk averse. With this new NEOS fund though, I am hopeful that this will be a much safer alternative. There's also one more benefit to this ETF that QYLD doesn't have, which is that it aims to be more tax efficient. Just like SPYI, this fund also uses Section 1256 contracts. According to this fund's prospectus, it says, "This fund seeks to generate tax-efficient returns by utilizing index options that receive favorable tax treatment under Internal Revenue Code rules because they qualify as Section 1256 contracts." Under these rules, each Section 1256 contract held by the fund at year-end is treated as if it were sold at fair market value on the last business day of the tax year. If the Section 1256 contracts produce capital gain or loss, gains or losses on the Section 1256 contracts open at the end of the year or terminated during the year and are treated as 60% long-term and 40% short-term, regardless of how long the contracts were held. In addition, the fund may also seek to take advantage of tax loss harvesting opportunities by taking investment losses from certain equity and/or options positions to offset realized taxable gains of equities and/or options. So with that in mind, a higher yield, more upside potential, and potential tax savings make this new ETF the superior choice in my opinion. But not everything is a bed of roses here. Although this is not unique to QQQI, I'd like to highlight something that could make this a riskier investment. The Nasdaq 100 itself has been known to go through some pretty serious bubbles. The tech sector crash back in 2000 resulted in the index taking about 15 years to fully recover in share price. The S&P 500 has never had a crash that big and likely never will. But given that this index again holds a lot of tech stocks, which many are riskier on average, I do consider QQQI to be a riskier investment than SPYI. If it looked like we were going through another tech sector crash again, then I wouldn't rule out the possibility of potentially selling this holding until things cool down. Someone on Patreon also asked why I would hold this NEOS fund if I also hold JEPQ. Because after all, both ETFs hold a lot of Nasdaq tech stocks, so it does seem a little redundant to own both ETFs. While I do think that is a fair argument, the reason I hold both is because both have different investment strategies that just work well. The NEOS fund targets a more stable share price and dividend, whereas JEPQ can actually have a lot more share price growth, but it has a lower yield. JEPQ also has more variation in its dividend payments, so that can make it a little more challenging if you're trying to live off it for your income. But with that being said, that pretty much sums up why I'm now holding this ETF over QYLD. Thank you all so much for watching today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.